Hey guys, how's it going? Welcome to the next part of the ASX series 0 to 100. In this one, we're going to be covering Woolworths. And that's the end of the video. Thank you so much. I don't think I need to explain the business model and all of that. I'll catch you guys next time. Cheers. Just kidding, of course. Yeah, I think most of us should understand the business model, but it's also interesting to look at as an investment prospect. So guys, this is episode, I think, 6 of the ASX 0 to 100. Let's get into it. Woolworths is one of Australia's leading retailers with multiple brands, including Big W's for, our everyday needs, Dan Murphy and BWS under Endeavour Drinks, which is, for all celebratory events or just a weekend if you're just feeling like it, all of whom have brick and mortar stores, including stores over in New Zealand. Now in Australia, Woolworths actually brings in one of the biggest amounts of revenues, not to be confused with profits, and we'll touch on that later on. But here's a quick breakdown. So in the Australian food business, they bring in about $42 billion. New Zealand brings in about $6 billion. Big W, $4 billion. Endeavour Drinks, which is both BWS and Dan Murphy's, is about $9 billion. And AHL, their hotel business, is about $1.3 billion, which is down 21%. And can anybody has a guess as to why it went down in 2020? Anyone?
Do me a favor, please. Get out of here.
Now, although these are big numbers, this is a business with quite thin margins. Unlike the resource sector or the tech sector, where the margins are relatively healthy, their gross margins, which is the amount that it sells for minus the cost of goods, is about 29%. So that's pretty good. And although the gross margin is at 29%, the cost of doing business alone is not cheap. It's about 23% of their entire revenue. And this is just for the Australian food business in particular, obviously you can see it on the screen, which leaves their earning margins to sales before interest and tax at 5.3%. Now, it's known that it fluctuates between, 4 to 6% generally for Woolworths. And so this is not a uncommon number to see. 5.3 is, seems about just right in the benchmark. Now, interestingly, out of the entire business offerings, the hotel actually has the highest margins out of the lot. And unfortunately, that's been affected the most. So although you had the highest margins, you were affected the most. But what's also interesting, and something that's obviously been purchased a lot during this whole lockdown period, is beverages, alcoholic beverages. And Endeavour Drinks, their margins is higher than the Woolworths operation at 6.1% and relatively low on costs, especially if people are starting to buy more drinks online. And actually, to my surprise, their lowest is actually Big W, who's only become profitable in the past couple of years with 90 basis points in terms of margins. So think of, the things that you go to buy in Big W, every $100, the margin for that is literally about 90 cents. So it'll be really interesting to see what to do in the future. I imagine Endeavour Drinks might get a little bit of a boost given their margins. And I don't know what's going to happen with Big W, just because we've seen what's happened with Wesfarmers. They're removing a lot of their Target shops and changing it over to Coles. So I don't think it'll happen in this case, given how many Woolworths shops we already have, but you never know. Now, getting straight into their finances, what's really been interesting is that the headlines have hit that although their revenues have gone up during the Rona, and we've seen it all over the news with lines and lines and queues of people lining up for stuff in Woolworths, their profits actually gone down. And that's mainly been due to all of the automation that they've had to pay for in a lot of these stores, and also all of the safety measures they've had to have implemented moving forward. And of course, this is going to pay dividends in the future, but at the moment, it's taken a massive hit on their profits. So overall, their earnings came in about $3 billion before interest and tax, with about $1.3 billion paid out in dividends. And for you dividend investors out there, Woolworths is definitely one of the solid ones, given, their constant cash flow and also the fact that it's fully franked. So the tax that you're paying on that is rather small. In fact, if I'm thinking of ASX listed companies, I would say Woolworths is probably one of the most safest and defensive stocks. Like, you're thinking the equivalent of like a Johnson & Johnson, where no matter what crisis or what hits, they've worked out the logistics, they've got all the products for, groceries and everyday needs. So people will be shopping there no matter what. Even if more money gets printed, they're actually going to be a beneficiary if more money gets printed, because that means people have more disposable income to be spending on things like this. Unless there's like food poisoning or like needles and strawberries at Woolworths. So like that's the only time that I could see people going away from Woolworths and then, you know, looking at their other competitors like Coles or Audi. Now, if we look at their balance sheet, we can see that their cash reserves is in the $2 billion range. And given they have a solid cash flow in their operations, their debt is rather manageable, even though it is relatively high. Now, I guess for a business like Woolworths, the only time that I would ever really be concerned is if they had to finance to actually pay out dividends for the investors. Like that's a big red flag for a company that should be cash flowing like crazy. So yeah, the balance sheet is looking pretty good in terms of assets and is manageable in terms of debt. So with that being said though, it's a steady business. So let's get right looking into the outlook. Now, if we're looking at Woolworths for an investment prospect, just understand that you're not going to get any crazy gains over time. Like unless another Rona or something comes about which forces people to buy a lot more for whatever reason the case may be. That's the only ever time that I see shares will hit crazy highs again, because people are just so reliant on the retailer. But because they control such a big market share already, there is nowhere else they can really grow. Like 25 million, 26 million in terms of people in Australia, like that's who you've got. And you've already got them. And despite the fact that there might be concerns around the fact that it's dipped in profits after tax this year, guys, understand it's a dip in percentage of profits. It's not a dip in like they've made no profit this year, right? And I think that those headlines can kind of be misleading at times. And given all the money that they've spent on infrastructure in terms of automation, they've changed aspects of their supply chain, and the fact that they've had to pay certain employees back who are underpaid, which obviously you have to do, and all the safety measures that they've taken, hats off to them. They've done quite well in terms of managing their cash flow. And this is all going to pay dividends in the future. And I don't mean the dividends to the investors, I mean for the business itself, which I guess will then flow on to the investors anyway. So yes, it will pay dividends to both the business and the investors in the future. So I guess overall what this business provides is that it provides investors with a non-cyclical business that operates basically 365 with one of the strongest streams of revenue in all Australian businesses, maybe tied or in line with like Wesfarmers or something like that. So they can always try to readjust and fine tune their operational costs and try to lower that in the future, try to automate a couple things in the future so that overall profits can increase and end up in either the share price increasing or the dividends in the investors' pockets. And like I mentioned before, no matter what happens in the economy, this business will continue to thrive unless like they get new management and it's really poor and, you know, all hell breaks loose. But yes, guys, it's a safe investment. What else can I say? Everybody knows it already. The video should have ended like 10 seconds that I got into this. But that's my thoughts on Woolworths, guys. Let me know in the comments below if you are invested in Woolworths shares. Shout outs to Woolies. I prefer them over Coles anyways. I'll catch you guys in the next video. Cheers.